So the objective of this lecture is to bring about some insight in the learning process of leasing in the subject SFM. Many a time students, either after attending to the class or after self-study, they come and ask doubts few weeks before examination or few days before examination, or the last hour, I would say 11th hour, they just ask questions. So at that point of time I thought, why not we try a video lectures which could be accessed by students at large at any point of time, especially on to the basic levels. The area where the students are having generally these doubts. Our institute had explained, but I don't know whether to blame institute or the students, but I thought I will act as a bridge between the two to make certain issues very clear. Today is 24th of May 2017, on which I am just taking up this lecture for a greater benefit of students community. So what exactly is the issue that we would like to take up? So I take an example, and through that I would like to explain this point. Cost of a machine is rupees 1 lakh. Term 4 years. A company had decided to buy the equipment for rupees 1 lakh, but they are to decide upon two alternatives: either buy, take it up on lease basis, or take it up by way of bank loan. So let me assume further information regarding bank loan. Bank loan is available at 10%, and the installments are paid on equal basis, equal installments, and we assume the rate of depreciation on SLM basis, say 25%, because it is running for 4 years period. With no salvage value, I take it up. Item number 3, when depreciation is taken up, I would like to take up taxation at 30%. Now the question is whether it is good to take up the machine, that being the asset, on lease basis or on bank loan basis. Understand, cost of capital from the viewpoint of the lessee is not given. This is the scenario under which we are taking up the matter for discussion. I would like to open, for the sake of convenience, Excel. This Excel sheet is just developed just for the sake of bringing quick computation and so we thought we will try through Excel. So of the two, we understand that especially for the bank loan option alone, people will ask a lot of doubts. I firstly handle bank loan, and then we will take up lease rental. Of course, for lease rental they have not provided us what is the lease rental. Let us assume that lease rental is 30,000 rupees per annum on RUS basis. Okay, in this background, let me take up the computation for your understanding. So As a financier, I would like to firstly take up the interest computation and principal computation. Just have a look. Yes. One, two, three, and 4. Opening outstanding, this being a lakh of rupees. We assume that it is 100% loan. Interest at the rate of 10%, which is to be computed on the opening balance outstanding. Principal being equal a lakh divided by 4. Closing outstanding. Say, please develop your opinion only after listening to the full lectures. And now, opening outstanding for the second year is nothing but the closing outstanding of the previous period. Say we work this way. So now the next thing which I would like to take up is interest after taxation. Because interest, when you debit, there is a tax benefit that we derive. So what I would like to take up is principal amount multiplied by post tax rate of 70%. What is the cash flow? Cash flow is nothing but interest after taxation plus the principal repayment. This is the outflow. I would like to develop one more table to take up the tax saving on depreciation. What is the amount of depreciation? Depreciation is going to be 1 lakh minus salvage value being nil, so therefore it is 1 lakh divided by 4. So tax saving on depreciation is 30% into this is an inflow. Okay. What is the net cash flow? Net cash flow is nothing but 32,000 outflow minus 7,500 inflow. So now net cash flow we have arrived at. Now PV factor is what we are going to take up. The problem did not carry the cost of capital. So since the cash flows are taken up on after tax basis, we should also take into consideration that cost of capital on after tax basis. Since they have not given us the cost of capital, we consider 7% as cost of capital, which is nothing but post tax rate of bank interest rate of 10%. If 10% is before taxation, leaving 30% for tax saving, 7% we will consider as after tax cost of capital. Now I would like to develop the PV factor Now discounted cash flow. What is the amount of discounted cash flow that we will take up? Discounted cash flow, how much is it you will end up with? Any idea? Round is multiplied by this. 74,596 is the discounted cash outflow as far as the finance is concerned. If you are taken up for the bank, and it is not to be considered as 1 lakh. Whatever we have paid is to be considered as 74,596. Now, as a person thinking of buying the machine on bank loan basis, we would consider this figure as 74,596. Why we take the trouble of doing all this? We could have just done the matter even simpler than this. What could be a simpler than this? We could have arrived at this figure of 74,596. So now what I would do is that I would like to build discounted cash inflow this way. What is discounted cash inflow? Round, I consider the PV factor at 7%, multiply directly this tax saving on depreciation of 7,500. I get 7010, 6551, 611, 6122. If I take up this matter, it comes to 25,405. All of you please understand, this number of 74,596 I could have arrived at straight away in this fashion. What is the cost of the machine? 1 lakh. 1 lakh minus present value of tax saving on depreciation, how much? 25,405. How much is the money that I am ending up with in my answer? It is 74,595. Therefore, it becomes redundant for anybody under examination conditions to work out the cash flow. Rather, you can work out this answer as cost of the project. Cost of the project, how much? A lakh less present value of tax saving on depreciation. How much is that? 25,505, and you arrive at this value this way. So people ask this question whether we should try this or can we skip this. So let me tell you, we can skip all the computation related to interest, principal, etc. And one more important thing that you should note, sometimes in our institute study material, equal installment, they don't take it up as equal installment on the principal alone. They would have applied equated installment. How this equated installment they would have arrived at? They will take up 1 lakh and they divide by annuity factor at the rate of 10% for 4 years. What is the number that you will end up with? Annuity factor at the rate of 10% for 4 years, 3.1698. Now you can just check up as what is the annuity factor here? 1 lakh divided by 3.1698. The answer that you end up with is 31,548. 31,548. Instead of assuming 25,000 towards principal, I can as well take it up as 31,548. Now see the result. I know the interest is going to be 10% on this, but since the installment amount is decided as 31,548, what I would do is that 31,548 minus the interest that I compute will end up with a different sort of schedule. Correct? Look into the next one. Look into the next one. Look into the next one. So at this point of time, I end up with negative 4.268. What I would do is that I will take up opening balance as principal repayment, and here the interest I will take it up as 31,548 minus the principal outstanding. So therefore I am ending up with the same answer as it was previously taken up on equal annual basis. So whether you handle the problem on equal installment basis or equated annual installment basis, your final answer will end up with the same number. Now I will do the control Z operation. Just see. So what was the number that you had previously? 74,596, and that is what we are bringing out here. Now control Y. Now it is 74,596. Same number we are just getting. So students, don't worry about whether the problem is to be handled on equal installment basis or equated installment basis. What do you mean by equated installment basis? This is a pure mortgage repayment installments. They take into consideration the interest and principal together as installment, and that figure will be same throughout the term. Whereas in the case of equal installments, only the principal amount will be equal, interest accrued thereon will be paid additionally. That is what we take it up as equal installment. So therefore you don't worry about whether it is equal or equated. Only in those cases where cost of capital is not given, and when you consider the bank cost of capital, the rate at which you borrow, whose post tax rate when you consider in the computation, it is not at all appropriate to try this. You avoid this working. What you do is that take up year computation, depreciation computation, tax saving and PV factor, arrive at present value of tax saving on depreciation, straight away deduct from the cost, and the final answer what you get is 74,595 is what we will be getting in this form. But I am just cautioning you, this may be used only when cost of capital is not given. If cost of capital is given in the problem, say 12%, whatever I said you please ignore, and whatever I said you please avoid this working. Now I can't say you can avoid this working. Now what is it you should do? You should continue to do the work in a traditional way. Have you understood? So have that in your mind, and when problem did not carry cost of capital in the problem, it becomes easier for you. What you do is that the other alternative cost of capital gross rate you take up. In this case bank interest rate is 10%, but for discounting purposes you employ post tax interest rate. So people might ask for why, what is the logic that we have? We can tell logic in a very simple way. So as far as leasing is concerned, bank loan is other alternative. The other alternative cost of capital is opportunity cost of capital for lease. Now let us just take up and complete the solution about the lease. If I consider the lease payment as, how much was that we have taken up? 30,000 rupees. Then lease rental after taxation is going to be on 30%, 0.7 post tax. Now annuity factor at the rate of 7% for 4 years. Since the cash flows are the same, we can sum up the PV factor and we can get the annuity factor. Annuity factor is nothing but 3.3872. Now you arrive at discounted cash outflow. Discounted cash outflow is simply the multiplication, the product of annuity factor and the lease rental after taxation. You end up with 71,131. What is the conclusion that we would be drawing? The conclusion that we would be drawing is take up leasing as the discounted cash outflow is lesser when compared to bank loan option. Now what I would like to do is that I would like to try this problem with cost of capital as 12%. Assume that 12% is given in the problem. Then we are not expected to use 7% here. Then we are expected to use 12% here. By doing so, the discounted cash outflow under loan option is 66,770 and in the case of lease it is 63,785. Okay. Now there could be another question people would be asking. What should be the lease rental so that it is matching with that of bank loan option? So if such a question is asked, I would like to take up this matter as 66,770 as the same number. Annuity factor is going to be 3.0374 because same 12%. Now what should be your lease rental after taxation? It is going to be 66,770 divided by 3.0374. What you end up will be 21,984. What should be the lease rental before taxation? 21,982.6 divided by 0.7. What you end up with as break-even lease rental will be 31,404. This sort of question is also possible. So it becomes very easy to crack when you are understanding the entire background as what factor is influencing your final answer. Are you clear? So this sort of problem they have asked as last but one problem in our practice manual of ICI. Okay, kindly go through and enjoy your session. One more important thing is that in institute practice manual they ignore in certain problems tax effect on the capital loss at the end of the term. The WDV of the asset may be some 15,000 rupees and the salvage value may be 9,000 rupees and there exists 6,000 rupees short term capital loss. In some of the problems they have ignored what? Tax saving on capital loss, but they have considered the salvage value, and in those problems they have put a note saying that short term capital loss is ignored and the tax effects are also ignored. In some problems they do that. In many of the problems they have considered tax saving on such short term capital loss as part of their cash flow. So ignoring it or including it may change the decision. So please be careful, and when you are ignoring it, put a note. When you are including it, there is no note that is required. Of course, with abundant precaution, you can just put a note saying that even capital loss may be ignored, and if that be the case, this would be the decision. So leave no scope for the institute to reduce marks. So given a chance, take the full marks credit from the institute. So you should prepare well in advance and find out what possible ways through which different answers may be erupting, and go prepared and be bold in whatever you are just saying, and don't be timid and accept institute material as correct in all occasions. As you all know that institute after some point of time they are releasing errata. That means until the errata is released, students would be believing that the institute answers are correct. So please just don't have that sort of feeling. When you know the concept, go according to the concept, because the guideline answers given to the examiners are not the same answer what you find in practice manual. Therefore, it becomes a duty on the part of people like me to form a bridge between institute and the students community. So, thank you.